From Barangaroo Studios, this is the COB, brought to you by eToro. Invest in ASX shares with $0 commission.
Good afternoon, and well, pinch punch, first day of the month. We're into June, of course, and it's well, great to have your company. My name's Kyle Rodder. Of course, I'm here with Danny Akuye, and Danny, a little bit of a bounce back, almost. I think. How are we looking as the market looks to close the day?
Yeah, a bit of a difference between the COB 200, but I've got the ASX 200 up about 0.3%, and really ticking higher around that 11 o'clock time, which was when I think we got the announcement that the US Senate, House of Representatives, had approved the debt ceiling. So after all that noise and this, that and the other, it's going off to the Senate. So I guess the market is starting to anticipate that will be done and dusted, but no doubt we'll move on to something else that is of equal potential calamity once this is done.
Well, it's the next step on that wall of worry, isn't it?
Exactly.
So we'll have to find out what that will be eventually. But anyway, as Danny said, that doesn't look quite as positive, the COB 200 as the ASX 200 did, up 0.3%. Of course, we'll get the match out in the next 15 minutes or so, and we'll have the final trade go through, and we'll tell you what happened for the day when that happens. But let's get to the three themes, because again, it's sort of a little bit quieter out there, remains the case. But thought a fresh start, new month, you can always sort of pin these sort of swings and roundabouts in price action.
Last month of the financial year, so don't forget that there could be tax selling coming.
I'm glad you said it first, because it's going to be something that we're all going to be questioning over the next 4 weeks. Every time there's a sell-off, whether it's tax loss selling. But another question, what's going on in China? I thought we doubled back to yesterday's PMI data, but we also had the Caixin, sort of more of a private sector. As I understand it, focuses a little bit more on smaller businesses as well in the Chinese economy, was actually slightly higher than expected. So yesterday's news was bad on China. Today's news wasn't good, but maybe a little less bad. Okay. So we did see the iron ore price rebound today too, which was good for some of our materials names. Yeah,
but did they actually perform? I didn't think they performed that
well. I think they were up marginally there for a little bit. They were certainly up, because they were off quite considerably yesterday. But I think
only up very, very slow. Well, I suppose BHP, up slightly, Yeah,
okay. So up slightly there. But well, last but not least, and I think this is probably the theme for the next few days, it's going to be jobs. Not maybe jobs here, but in the United States.
Yeah, but also we've got those public sector wages negotiations coming out tomorrow, which is
Fair Work.
Which is important, because AMP was just saying if they're above 5.5%, then they think the chances of an RBA rate rise next week will go right up.
I would love to see the RBA. It's such a cliche, but we talk about optics in politics and optics in public when it comes to, I guess, PR for these institutions. How would it look if the RBA, off the back of that information, hiked interest rates? I don't know how they'd sell that.
It's already the probability's going up because of that inflation read, that 6.8%.
Yeah, that was a bit
okay,
spicy.
So it was a bit spicy, even though you can argue the toss about all the mechanics of why it was that high. Yeah. But it probably will be the RBA just needs to catch up, is going to err on the side of maybe we do need to lift again.
If that Fair Work comes in high and the RBA hikes, you can guarantee the Guardian will explode. There will be hate articles everywhere, and the public ABC as well, everywhere. The public discourse won't be very friendly. We'll see how we go. Of course, time's going to tell. It's 2:30 Tuesday next week.
The machinations of economies. It's never easy, is it?
No, I could digress into an anecdote. I won't, because I do that too often. But let's get across some of the sectors that we're moving a little bit today. Get back to tech, which was, I suppose somewhat mixed. Computer share tends to be a bit of a yield play there often, or an interest rate story quite often. But those sort of more pure tech plays actually looking pretty good. Xero back above, actually nearly $112 a share again. Altium and WiseTech Global. WiseTech's probably been the shining light, really.
Absolutely, WiseTech has been really, really a shining star. I was just wanting to have a look what's going on in the bond markets, because I was just wondering, given that some of those sectors that have been performing well today, so we've had tech, healthcare, gold, which you're going to touch on, All quite yield sensitive. So maybe that risk, you know, there's because of the deal coming through or the perception, we had seen, you know, quite a lot of selling in US Treasuries.
Yeah,
and yields moving up. So maybe we're going to see the reverse coming through, and these sectors, of course, would be beneficiaries.
Well, what was interesting last night too was that we did have those JOLTS numbers that came out higher than expected, but we also had, and I can't remember his first name because he's only becoming, there you go, he's only becoming a little bit more familiar to the public, but apparently Ira Epstein, who Andrew was interviewing today, was saying he's sort of in line for the deputy role at the Fed effectively, which is currently being occupied by Lael Brainard, quite dovish last night, talking about the potential that, you know, they might pause in June, which sort of shifted market pricing away from about a 60% chance of a hike next week.
70,
yesterday it was close to 70.
Yeah.
Today it's about 20 to 30
yeah.
of a hike. So I think that was off that commentary. Maybe that sort of benefited those more interest rate sensitive names, which again, we'll look at gold now because gold was quite broadly higher as you can tell there. In fact, we'll look at the leaders and laggards later on, but Perseus Mining and De Grey, which also had an upgrade yesterday, doing the best of all, right up the top of the pops today. But lithium also bounced back.
Lithium back on top of the pops.
Actually, a bit more mixed there. Mixed, I have to say. But some of the names in the top five
were lithium up,
names.
But all the others really subject us to some profit taking.
Pilbara there obviously being a good proxy for the retail trader out there that likes to get exposure to things. But corporate stories. Couldn't find much that really moved the dial today. There was that BHP story around, underpayment of employees.
That's been kicking around for a while though, hasn't it?
Well, I don't really follow it too much because it doesn't really move the share price too much. Obviously, it's a governance issue, it's a social issue more broadly, but it doesn't seem to shift the share price a great deal. Certainly didn't today.
No.
Imugene was off quite considerably. Trouble finding information on that. We'll talk about it a little later on. But one news was that it dosed its first patient cohort in the Imprinters study. So it's a little bit technical.
Did they kill the patients? Because it's down 7%. Sorry, I don't know. It's just like
I don't know. Maybe they did. It was maybe not a successful
that was
study.
Danny foot and mouth.
That's right. Well, we're a streaming service, so we can do worse than that, and maybe we will by the end of the show. But Champion Iron also, its share price down was 2%, and it has been selling the iron ore shares price following its full year results yesterday. It's nice to know a human life is worth about 7% on a share price move. Anyway, let's get to the stock of the day because we've had a big consumer focus, haven't we, recently? Yeah, talking about it a lot.
Those consumer discretionary stocks being hit, and obviously expectations that those interest rates are starting to bite, some downgrades in earnings.
Well,
no one's died.
We did. No one's died in the consumer space, fortunately. But Universal Stores results were a little bit weaker than expected recently, and we had Grady Wolf from Bell Direct and Mark Gardner giving their views with Nadine Blaney today on the call.
Like they're quality companies. We've got some of the best retailers in the world in Australia. I just think, consumer discretionary is the part of the market that performs the worst when we hit the recession. So in the US particularly, so probably just best to, we've sort of been advocating, make a shopping list of those companies that you really want to buy, like, excuse the pun for the retail, but make a shopping list of those companies and just set levels where you want to buy in because they'll be the best buying opportunity for 2 or 3 years once we cycle out of this. But we've been talking about this recession forever, but it's likely to materialise.
Accent Group is our choice in the retail space. We have a hold on other retailers like Best and Less, City Cheap because of inventory levels. So when we're looking at retail stocks, we look for inventory levels, we look for headwinds and high rental costs. The thing about Universal is they have high rental costs, and which is inflationary at the moment with the RBA's interest rate hikes. So again, there's a high cost that they're bearing, and also with the expectation of consumer spending to come down, the Accent Group is not in the Universal stores are not in a great position to weather this storm. Whereas the Accent Group is the reason we have a buy rating because they target the younger demographic, like the Universal stores, but Universal's is slightly higher age group. The Accent Group is like the sneakers, TikTok age group, buying sneakers with their first paycheck, no cost of living pressures at all. So that's why we like the Accent Group.
There you go. So I guess the message there was, if you want exposure to a very difficult sector at the moment, maybe Universal Stores isn't the place to look for it.
Yeah, absolutely.
Yeah,
Very, you've got to tiptoe through that sector, I think, at the moment.
Yeah, you don't feel like a full recession's priced in just yet. But anyway, we digress. Let's get to our guest for the next 8 minutes or so. Fraser McLeod from Shaw and Partners joins us now. Fraser, great to see you there, and do hope you're well. But I wanted to start on the uranium story because it's been in the news the last couple of days. We were kind of speculating a little bit before, just what the nuances here are around this situation in Namibia in particular. But I mean, how are you reading the uranium space, broadly speaking, especially as it applies to this Paladin story?
Yeah, sure, absolutely. We'll definitely dive in on that in a moment. I think just to preface that, we have a very flighty market at the moment, and whilst there has been some stocks within our market that certainly earnings are going in the right direction, that number is probably dwindling, and so the market is really relying on stocks, like maybe CSL and Zero and maybe Transurban, NixDC, those type of stocks that had pretty positive statements out in terms of earnings. But the rest of the market is very much from a shareholder's point of view, and those marginal investors, of which there's probably a greater number at the moment that have their finger over the sell button rather than the buy button. Those type of investors are pretty flighty. So it is more than normal. We are in a market whereby investors or traders are shooting first and really asking questions or asking the questions that they should be asking later. And this week we did certainly see Paladin, but there's been other stocks over the past few weeks. Stocks like maybe Elders or Syrah or your Treasury Wine Estates or IDP Education a few days ago. And then this week certainly Paladin was probably the big focus one on a sudden political risk story that came out. That story was not comprehensive in its nature. It was related on a newswire, and the flavour of the story wasn't quite true for the true taste of it. But so Namibia, as it turns out, it didn't really surprise us, but as it turns out, eventually over that sort of 48 hours of digest, Namibia is not turning communist, and they're not going to nationalise mining companies that are already and have been just nice and steady over the past 20 years, investing in that country. They're probably politically within the country of Namibia. They've had some amazing oil and gas finds, and the government is probably just vocalizing and making sure that on those future oil and gas finds that they're going to be to the benefit of the country and the country's people, and that's all very fine. The Paladin was, however, down 20% on that news within an hour just a couple of days ago, and it really has taken a couple of days for the market to digest the story, realise that it's not quite true, and in fact it's far away from the truth on the initial headline, and that's why we've seen a very dramatic recovery in Paladin today. I think it was up about 10% on the end. It's political risk within mining companies is just another risk that we always have to deal with. We've historically had to deal with it. We have to deal with it this year, and we'll certainly have to deal with it next year. It's just another risk to balance off on top of commodity prices, capex on big projects, and environmental risk. And the moral of that story is that this is not going to go away. We have to be pretty balanced and look at the facts rather than getting carried away on the short term shoot first and ask questions later attitude. In fact, there's probably we can take that even a step further and say that there's probably good opportunities if we're able to take advantage of that theme currently happening in the market. So the background obviously on these uranium stocks are there's huge energy demand. There's certainly demand for energy security at the moment. There's demand for decarbonisation solution stocks, of which uranium, that's a big tailwind. And the Paladin has been and will remain so in our market, being the most liquid way in order to play that theme. The restart is ready. And but obviously the stock was smashed a couple of days ago, and it's now looking very, very cheap. So in our eyes, the stock could double over the course of the next 12 to 18 months, and our target price remains $1.30.
Fantastic, Fraser. So as you say, with this really flighty market at the moment, sell first, ask questions later. Just honing in there on that thing that things get really overdone in the same way as they get overdone on the upside, then they get overdone on the downside. And I was just looking at like IDP, that was off another 6% today. And, you know, the fall is really substantial. Do you just think everybody's kind of throwing in the towel on this one? And it's like, you know, because it has been historically one of the great sort of quality growth stories in the immigration sector.
Sure.
But, you know, it's very loveless at the moment.
It is. I think that perhaps yes, agree. And my angle on that, just to take it a step further, would be investors tend to be looking at the potential negative of a story and pressing the sell button rather than digesting the story and making an informed decision. And that does breed momentum in the absolute short term as well, because it rewards those that press the sell button first in the absolute short term. Now, for medium-term investors, which is mostly us, because you know in the medium term you're making an awful lot more money than anyone else. If you can survive and stomach the pain that we've seen in stocks like maybe Elders or Syrah or you know IDP Education, there's a place where the value just becomes so obvious, even taking into account the risk event that's already taken place. But my point would be that you know people are not even measuring what the true risk is, or even finding out the truth behind stories. They're just simply pressing the sell button, which is bizarre and is a new theme, or is just more an extreme theme in today's market. So investors are more inclined to take a glasses half empty attitude rather than finding out the truth.
Just also wanted to talk about another couple of uranium names that you think might be, or I believe you think might be, reasonably attractive, good ways to play it. I think Boss Energy is the first.
Well, one thing that we would discuss with clients, of course, is that we're not locked into if you wish to exclude the uranium potential political risk of investing in Namibia, then there's other ways you can play it. Here in South Australia, Boss, which is pretty much on the same time scale as they own the Honeymoon project here in South Australia. They'll probably come to production next year. Part of their book is already contracted, but they've got plenty of uncontracted potential into the future. Prices are rising. Demand is certainly increasing, and the supply question is one that's becoming a lot more difficult to answer. So yes, we can take on board companies like Boss or even NextGen, which is probably the biggest resource stock that you haven't heard of. NextGen is a Canadian company. They have a CHESS depository interest secondary listing on our market, and they're 100% exposed to the rising uranium price. They're worth a couple of $2 billion, and so they're a mature market cap already. But potentially could be an awful lot bigger if they get the environmental permitting, which is likely that will happen. Then they'll build that mine, and the payout for that mine in Saskatchewan in Canada is an 11-month cash flow pace for in terms of payout. So incredible potential there from 3 uranium names. I think the point that I'm raising here is political risk is just a normal risk alongside any other. And we should digest news and really act on the facts rather than pressing the sell button straight away.
Yeah, okay, that's a good moral of the story, I suppose, and perhaps a nice place to leave it as well. Fraser, really appreciate the top-down insights there. Hopefully we will chat again soon. Fraser McLeod from Shaw & Partners.
Thank you.
Good on, thank you.
Okay, well, let's get across the leaders and laggards now. Well, let's start with the good news. Leaders, shall we? And I dare say there's going to be a few
Paladin.
gold and, well, Paladin's up there. Yes, we spoke about that a lot. And I don't know if I could spell it out any more eloquently than Fraser just did. But 61 cents now, 12% jump. Not reclaiming the full extent of the losses yesterday, but hey, that's
going in the right direction.
Going in the right direction, exactly. Yeah. Degrey Mining had a chat with a young fellow named Rudy Philippe van Dijk this morning, just around that one. It was a broken move. UBS upgraded it yesterday, so perhaps had the tailwind of the gold price,
absolutely,
as well as just that extra premium place on top from an upgrade as well.
Yeah, and then we've got Pro Medicus, which is up 3.5%. No news on that one. But maybe just it's been tracking sideways, for really, a few months now, or it's come down a bit. So maybe people doing some bottom fishing, if you can say, because it's not the cheapest stock on the market.
No.
But it moved with the healthcare sector generally today.
Yeah, and it seems to be sort of, if the healthcare sector's not done too badly recently with this whole sort of defensive skew. Pro Medicare seems to be the laggard of the pack.
Correct. Yeah.
I say that because I was unfortunate enough to buy it about 3 weeks ago. So anyway, it's you buy it for the long term, of course. Yeah, exactly. Just being cognizant of that one. But that's the leaders there anyway. Laggards now, shall we? And IDP education, which you just sort of wonder now whether that's really starting to see some of those technical factors that play in when sentiment shifts.
Absolutely, it becomes a momentum play, and people watch the share price go down, and then they, as Fraser was just saying, they don't actually do the fact checking. And I suppose some people are saying, well, there's this overhang about competition coming into the Canadian business, but they've handled it in other markets. The brokers have been quite firm, even if you don't believe the brokers. You have to question whether or not this is starting to be overdone, but as per usual, everything gets overdone to the downside and overdone to the upside.
Definitely. And
the momentum at some stage will switch in the same way as just looking at Elders, which of course was on that side of being sold off, wasn't it?
Yeah.
Day in, day out, it looks like that's stabilising
starting
now.
To bottom out, yeah. And I was just in my boredom the other night, just flicking through YouTube, Warren Buffett videos at the conference that they do, and he said, it's very, very hard to outperform the markets because they're so efficient nowadays. But he said you can always trust on people doing stupid things, and that's when opportunities arise. So maybe people are going to sell, and someone's mistake could be to your benefit. As brutal and zero sum as that sounds. Champion Iron. We spoke about that before. Imugene, that poor soul that Danny was speaking about, I do believe. And IGO Mineral Resources, actually commodities still underperforming a little bit.
Yeah, interesting. Mineral Resources back down to $68. So I'm sure the chartists would have something to say about that one.
Indeed. And let's get to the small caps, if we will. Any of the names here that jump out? Not necessarily. Nadine's normally good with these ones, actually. She's our sort of small cap pro. Not me today, though, but you can peruse that yourself. The laggards now of the small caps.
Hastings Tech. Now, I talked about that. I think there'd been a broker downgrade on that one. So their capital expenditure on one of their big projects, or their only project, has gone up substantially. So they're going to have higher losses, and that's probably why that stock is trading down almost 13% today. Sadly, I can't add any colour to the other ones.
No, but if you can see it there and you're involved, well, at least now you know. But before we go, let's have a look on what's on overnight, because it's actually a little bit as far as the US economic calendar goes. First, European flash CPI, which for a very long time, EU CPI wouldn't do much to markets because it was always below target. But of course, we're in a brave new world now, and it's a high impact event, so we'll keep an eye on that, because, well, the implication there is that the ECB is still likely to continue to hike throughout the rest of this year.
Germany's already in recession.
Yeah, that sort of whole notion of stagflation over there has been a pretty persistent theme. US jobless claims backing up on the jolts last night, leading into the NFP tomorrow, and ISO manufacturing PMI.
Right, so that'll be interesting, because a lot of those PMIs have really been in contraction territory, haven't they?
They have, and we also have that story around a divergence between manufacturing and services activity. As I suppose the economy recalibrates now, we're back into sort of more normalcy overall. But it's often said below 45, which is not expected to drop to.
That's below 50.
No, sorry, below 45 is associated with the US recession.
Oh, right.
So it's contracting, and then once you go to
45.
Below 45, it's like 100% strike rate.
All over Road Rover.
That's it, yeah. You start calling it there. If there wasn't enough reason to already call it, I suppose, inverted yield curves and the rest of it. So that's going to be pretty crucial tonight. So we'll probably wake up to a little bit of news to digest in the morning as we head into those NFPs, like I said. But Danny, I think that's another day in the books.
Yep, that is another day. Yep, first day of the month.
It is.
Last month of the fiscal year here in Australia.
Yes, and
so the year is disappearing very quickly.
Yes, such is life, I suppose. But well, I'm sure we'll be able to squeeze in more of the tax loss selling and all the other sort of things that we can pin any sort of unexplained move on in the next few days. But for the time being, it looks like European markets will open reasonably strongly. Wall Street futures are looking a little bit flat. Remember, you can catch up on all our news and interviews on our website and app. Well, until tomorrow morning, I hope you have a great night.
Absolutely.
The COB is brought to you by eToro. Invest in ASX shares with $0 commission.